Uh, so before we hop in there, these classes are in Blitz series. So what that means is they're 30 minutes or less, and they are designed to just get you guys the hopefully the most relevant and useful information on any given topic without a lot of the fluff and all the filler stuff that just gets to that 1 hour and possibly makes it so you can have CE and all that other nonsense. So we'll hop right in there, and we are talking about credit. And so if I go right in credit, if I were to like try and break down why credit is um, useful, it does a pretty decent it does a decent job at trying to predict what someone will do in the future based on what they have done in the past. So it's a they do a quick snapshot. Obviously, all of you guys are pretty familiar. You have your own credit. I always tell people, especially those that are trying first time home buyers, it's a game that they're likely playing that they don't even know the rules to, and that's true for the majority of people out there. But one thing that on the from the mortgage lens, credit does a few things. It indicates how likely a person is to make payments on time. It can be a factor in the type of mortgage a person may qualify for. It can help determine the amount required for a down payment. Sometimes with lower credit scores, whatever, maybe more is required to be put down. Different programs open up at different credit scores sometimes, and um, it can be a good deciding. It can be good at deciding the amount of money a person can borrow in relation to their income. So there's a little bit more flexibility sometimes with higher credit score, and it can determine the interest rate offered. So one thing that is very true is um, the lower the credit score, the more that an investor perceives that that is risky. The riskier it is for them to invest money in a mortgage where the credit score is lower. And it kind of makes sense, right? Like historically, if someone struggles to make payments on time or chooses not to, or whatever the case may be, doing their best at trying to analyze that would determine, like, okay, maybe that is a bit more risky than someone who historically has never had an issue making payments on time. Although it's not to say that that person with an 800 credit score can decide to just not make their payments one day, and same with someone with a 600 can choose to just make all their payments. It's not a perfect system, but it is one that is used and is useful. So the next thing that I'd like to hop into before I go on to the next slide is what you guys are probably noticing in the industry right now, which, and if you haven't, maybe you'll come across it now that I mentioned it. But a lot of lenders are choosing to offer what's called a soft credit pull as opposed to a hard credit pull at the pre-qualification stage. So at the early stage, when they're first getting a lead, they're doing the pre-qualification, they're doing the work that they're then going to provide a pre-qualification letter over to you to determine whether or not someone's qualified. A lot of them are now offering to do a soft credit pull as opposed to a hard credit pull. And I'll just highlight one reason. So obviously, from a lender's perspective, the reason is generally, we just want to make it user friendly. But if you get down into the weeds, I think it would be probably disingenuous to ignore the fact that the cost to a lender of credit pulls, more specifically to pull the credit report, so a tri-merge credit report, has gone up from like $30 to $40 in 2020 2021 up to over 200 in a lot of cases right now. So with that increased cost, magically now this consumer friendly generous thing of soft credit pulls has come in there because the soft credit pull is much cheaper. That's my opinion. That's the hard take there of the controversial take of why that is existing. In a lot of cases, it's just to save some money. So if we were to hop in here and I were to talk about it, myself and Monica are on the same boat right now, where we do not do soft credit pulls, and we'll kind of explain. I'll take a next couple slides explaining why, and then you guys can kind of decide for yourself what you think about them or don't think about them or whatever. So the first thing is, this is an example of a real credit report that was pulled. It's a hard credit pull. And you'll notice that you have Equifax here at the top, Experian, and TransUnion. So it pulled all three, hard credit pull. And you notice that Equifax has a 519, Experian has a 689, and TransUnion has a 555. So for mortgage purposes, the reason that 555 is highlighted in green, we always use the lowest middle score. So if it's just one borrower, it's going to be the middle score, which 555 is. If there's two borrowers, it's going to be middle for borrower one, middle for borrower two, and whichever one of those is lower. So for our purposes, if we just pulled, let's say we chose to pull at pre-qualification, we pulled a soft pull. And I'll get into a little bit of nuances probably later with it, but let's say, it was closer to the Experian view of things, and it said, they're in the 680s or maybe even higher if it's a soft pull, who knows. So we do the pre-qualification, we get them pre-qualified, we show them the rate, the cost of things, we give them a letter, we give you guys a letter, and we say, hey, good to go. They go out, they find a home, they start putting money into different things because of that. They, start planning a bunch of things. They're emotionally attached to this, so it's that could be pretty brutal sometimes. But they're also financially attached to it now as they start to pay for things like the home inspection. Anyways, at that stage now that things have moved, well, the lender still has to pull a hard credit pull because Fannie and Freddie are going to have no business, no desire, even looking at soft credit pulls. They don't care whatsoever. So they're going to pull the hard credit at that point in time. And what they're going to realize is this person has a 555. Which probably, not every case, but probably means that person is not going to get that mortgage anymore. So there you go, right? So this would be a clear issue with using soft pulls at the pre-qualification stage. I can understand how consumers would like it when lenders, if they're looking at one lender that says, hey, I'll just do a soft pull, no worries, and another lender saying, hey, I'm going to do a hard pull. I can see the draw for the soft pull, but the adverse nature of it, not good. If you were this borrower and you got to that stage and this is what happened, trust me, you would have appreciated not having a soft pull. So if I go into another scenario here of credit hard versus soft, this is another one where, let's say we did that exact same thing, and this middle score is 627, but for Experian, let's say we just pulled again a soft pull and it was around the 611. And now we're sitting there and we're operating under the 611, which sometimes above that 620, it unlocks more things, whether it be Alaska housing as an option or different programs, different state programs or different programs in general. Some of the rates, again, vary in cost and structure. And so let's say we did the soft pull and was like, oh, this doesn't look like it's really going to work. Like, we'll try and run some numbers, see if we can make it work. And it's, not really working out. Well, you could have very well turned down an individual or presented information to an individual that was inaccurate, whether it be the fees that were listed or the programs that were available because of the limited nature of the credit pull that you were doing. So really important, in my opinion, that the hard pull gets done. A lot of consumers, the downside to the consumer in their mind, and this is education, lacking a little bit, is if I get my credit pull, the hard pull done, it is going to negatively affect my credit score. The answer to that is yes, but it's much less of an impact than they think. So I don't know how many of you guys check your credit scores. If you do, you'll notice like 1 month it could be at a certain number, let's say 700. The next month it's at 680. The next month after that it's at 720. And all the meanwhile, you have done literally nothing. And so that the scores fluctuate constantly. And the fact that hard pull gets done and maybe drops the score by 5 points or whatever the case may be is much less impactful than just having incorrect data when you're trying to get pre-qualified on a home and can't get the home or whatever at the end of the day. So obviously a huge proponent for hard credit pulls being done. I don't know if I need to go into that anymore. I will die on this hill right now. I get that they're more expensive for a lender, but I'll still die on the hill. And the reason, by the way, just really quickly, and this is kind of on a tangent, the reason that lenders are so keen on the cost of credit reports is because the majority of credit reports that get pulled, when we pull it, we have to pay for it. Well, a consumer, to pass along the cost, that cost doesn't get passed along unless someone possibly closes on a loan later on. And so you're left as a lender on the hook for, quite a few credit reports that you're just paying out of pocket for. So you can kind of see how that's a hot topic there, and especially when that cost keeps going up and up. All right. So test your knowledge. So I'm going to give you guys a couple minutes, and I want you, with the 10 things that are listed here, I want you to label them 1 through 10 with 1 being the action that would have the greatest negative impact on your credit score, and then 10 being the least negative impact. So 10 or 1 being the worst thing that could happen to your credit, 10 being not as bad as number 1. So I'll give you guys a couple of minutes to kind of maybe put some numbers next to this, jot it down or whatever. And we'll kind of go through that because I think it may be a bit surprising to you. And I don't know, I think Monica had mentioned if you do have questions, and I think I see some coming through, but use that Q&A area. Easiest for us to track at the end of the day. We'll be sure to answer them at the end.
Yes, we do have a couple, so just keep them coming in.
Sweet. I would just do another minute or so. If you don't have time to do all of them, maybe do your number 1. What do you think the worst one on here is? If this happens, then your score tanks the worst.
We've got some guesses in the Q&A.
Ooh, very nice. Okay, we'll move on. What were those guesses? We're closing out the Q&A. We'll actually give you 30 more seconds. You want to throw it in the Q&A? I didn't even think of that, to be honest. Good work. But whoever just put your number 1 guess in there. What do you think of as the worst thing that could happen on your credit score? To your credit score.
One of them is a very common one, and that gets guessed, and that is tax liens. So there's
Okay.
one, and then I'm just gonna kind of spill the beans, but the other number 1 wrong answer is inquiries.
All right, let's get into
I'll
this.
let's take it from there.
Okay. All right, number 1, late on a mortgage payment. Surprise, surprise. Pretty bad, pretty brutal if you miss your mortgage payment. I advise anyone not to. Is especially brutal missing a mortgage payment and then trying to get a mortgage. I mean, there's carve outs even in the guidelines where they specifically look at the credit report, whatever your score is, but then they dive in like how many times have they missed, how many lates on specific mortgage type stuff. So it can be pretty brutal. Don't miss mortgage payment. Late on an auto payment, also not great. Late on your credit card payment, late on department store card. You can see a bunch of lates holding up the top end of here. Debt ratio on open accounts too high. So your revolving accounts like your credit card, you have your balance on your account is high in comparison to your overall limit. Not great, not great. New trade line added within the last 3 months. Past due amounts, judgments and tax liens much lower than people actually typically think, as Monica mentioned. Too many accounts open with a 0 balance. And too many inquiries in the last 120 days. So the one that people stress about the most consumer wise, I would say, and Monica, you can tell me what you think, too many inquiries, they're worried about it getting pulled, has, at least on this list, the least impact. And that's probably if they're doing multiple, because it can add up if you're getting it pulled a bunch of times over a short window for different credit line items. But yeah. So hopefully that helps. Obviously, you try to avoid all these things, but some of these things have a greater impact than others, for sure. All right, so credit tip number 1, maybe some social media talking points or client talking points. Wanted to kind of throw some stuff out there. Credit cards uniquely are the only account type factored into two categories of your credit score: your payment history and your utilization, which is what I mentioned on that prior thing, making them have the heaviest impact. So credit cards do get factored in a lot, and unfortunately, probably have the greatest. I don't know if this is statistically true, but I would imagine if people miss the most payments, probably credit cards being, the pretty. It's pretty easy to miss a credit card payment in comparison to some of the others, but yeah, pretty detrimental impact in a lot of cases too. Having open credit cards, reporting positive low balances and on-time payments will gain you the most points each month they report. So really important on credit cards and just credit in general, but credit cards in specific. If you're using the card and you have a low balance, and you pay it off, and you're keeping a low balance on it, and you're using it, really positive impact over time on doing that. If you're carrying higher balances, pay off the cards with smaller balances first to help offset your overall utilization. So there is utilization from like a card to card perspective, but then there's like how much overall in general. So if given an opportunity, you know, that snowball effect, just start paying the lowest one, like try and do something, because sometimes people can get pretty overwhelmed, and you can target some of these and it can have positive impacts quicker, with some meaningful targeting of those debts. Don't pay your cards off every time you use them. If the balances always report zero, they look inactive and won't gain you points. So doing this instead. So in other words, what you might do is use a low thing, pay like, well, it's not low anymore. Sometimes I don't know, Monica, I don't know if you want to say, like, if you use this at all, but I used to say like fill up your gas tank and that kind of thing, but that's kind of expensive nowadays. So maybe don't fill. But you buy a candy bar or something, let it drag over. You don't have to pay interest on it. You don't let it go on for too long. A statement populates and just pay it off. It shows that things are active, things are moving. You're using your credit. It's a game that you're playing, and you keep moving along. All right, so what if simulation? So for those borrowers or consumers that maybe when they come to us, they don't have perfect credit like the majority of us out there. They have things that maybe the score isn't where they want it to be. They want to see improvement, whether it's to get a better rate or even just qualify for a mortgage in general. Both myself and Monica operate in the same way, in which we want to give them a roadmap. It's never good enough to just be like, oh, well, sorry, you don't qualify for a mortgage. Maybe come back to me in the future. You want to give them a roadmap, something to work on. Whether or not they're going to work on it, you can't control, but you want to help them, at least give them some pointers and tips and ideas and solutions to their problem, rather than just telling them they have a problem. So here's an example of it. So think of this simulation as we're going to upload a credit report, or the credit report gets held in there, and we're going to do a little simulation based on that the data in that credit report to determine what the impact might be if certain positive events happened. How much could it possibly increase their score to? So if you look at this example here, you see the time frame is 2 months. So it's saying if you do something now and you wait for 2 months, the score could possibly, your score right now is 585, it could possibly go to 652. It's never a guarantee, but they try their best to get it as accurate as possible. And the sooner that someone does these items, the better, because if you did it a month from now, that estimate is no longer, it's thrown to the wind. It's like, it's meant and designed to be like, okay, try and do these ASAP, because that's where you're going to get the most impact as far as where the estimate falls. And so the actions that it's saying to take, it's going to take a total of $993 from this borrower. And it says, it's telling them to change the balance to $2 on the credit union one account, which requires $993. So there's where the money comes from. So it's saying use $993 to pay down your balance on the credit union one account to $2, and then open a new credit card with a credit limit of $300 and a starting balance of $15. So get a new card, have a starting balance on there where maybe you buy that candy bar. Certainly don't fill up your gas tank. 15 is not going to get you down the road. And then with those items, it estimates that the score within 2 months of doing that would get up to around 652. And the difference between 585 and 652 in the mortgage world is astronomical. Like, that is huge. It opens up a ton more options. It opens up the ability to not have to do manual, like just a bunch of stuff. So pretty big impact from that perspective. Another example, a little less simple would be the current score is 515, could get up to 624. It's going to take them $2,279 to do so, and they still have to wait 9 months. But it's a roadmap, and it's telling them to change a couple of the balances on a few of these cards and accounts. And it's a roadmap that they can follow. And if they follow, it will increase their score. And certainly, gets them pretty close to 624 in a lot of cases. It's not too far off when someone actually does pull the trigger and do this, and we do a rescore after these events have posted. It does a pretty good job. So last thing I kind of want to talk about on the credit side, although it's getting better at the moment, they're trying to pass the stuff and it officially passed, but you know how things take time. Just know that, and we tell consumers this as well when they're getting a mortgage, anytime your credit is pulled, it's not a secret thing. Behind the scenes, that data, just like all the other data in our lives, is collected. And unfortunately, in this case, it's also sold. It's not necessarily that they're selling super personal information per se, or at least, that's what they lead you to believe. But the data from the bureaus, so the bureaus, you pull it through there, and the bureaus, they sell that information. It's called trigger leads. And what that does do is there's companies that will pay for that information, and then hello phone calls. You're going to get that consumer's going to get blasted to oblivion with get your mortgage here, get the best rate ever possible here, and all of that. And so we try our best to help them navigate that unfortunate environment. There's different things that even you guys could do if you're wanting to just be spammed less. This just doesn't have just to do with mortgages. It has to do with all spam, whether it be credit card crap or whatever. You can visit donotcall.gov. There's registries out there that you can just get your name on there to keep you off of their it's do not call list, where you get on there and people have to follow that. I mean, assuming they're following the law, they'll follow it, which is a whole different topic, but you try your best. And it does limit quite a few that actually do follow it, but also not everybody. All right, so here's a little toolkit, little worksheet thing that we can send to you. If you want, just type credit 101 into the Q&A section there, and we'll send this off to you. It's just a little snapshot thing of some important little tidbits and things to remember as you go forward, all things credit. Yeah, so put that in there and we'll go ahead and send that off your way. As far as the next class coming up, I get to go back to back. Monica is tired of teaching. She went back to back, just kidding. So I'm going to be teaching about retirement loans on April 6th. So think reverse mortgages. And if any of you have a sour taste in your mouth when I just said reverse mortgages, please show up to the class. It would be helpful because math doesn't lie. But at the same time too, I understand where people are coming from. So there's much in this class to unpack. 30 minutes probably doesn't do it justice, but I'm going to try my best to get as much in there that's going to be useful from your perspective as a real estate agent, to not be afraid of these reverse mortgages and understand that there is a time and place for them, and people truly do benefit from them. Not in every case, but in some cases it does work, and you find someone that knows those cases and work with them. So, all right, questions. Monica, take it away, huh? Questions?
Yeah. That was so good, Jared. I felt like I was a bobblehead, just like, yes, 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 yes. Totally agree with everything there. And just one plug on that reverse mortgage, like I believe in it so much that my mom has one. She's a perfect example of who it can be really great for. So make sure you register for that if you haven't already. It's really great. Okay, on to questions. All right. What is the fastest way to raise a credit score before closing?
All right, so I'm assuming you mean like okay, so that's just the fastest way. So if someone is in
What's the
contract,
fastest way to raise a credit score before closing?
okay, so let's say we pulled it on pre-qualification and someone's working on it, or even just in general, because at that time we're usually pulling the hard pull. So I'm not going to work through the scenario of someone doing a fast pull, or sorry, a soft pull, and then they're in contract, and now it's like, oh crap, what do we do? But at the time of pre-qualification, if we're working with someone and they're like, hey, what can I do? Generally the fastest thing, but not for everyone, because not everyone fits into this category, but the fastest lever is usually credit card utilization. So if someone has high balances on their revolving, so their credit card accounts, paying those down can increase the scores, usually in like 3 to 10 days after once it reports. And sometimes those bumps can be quite significant too, depending on what that utilization looked like, paying those down. And it doesn't have to be down to zero. Sometimes it's like a sweet spot of 30% or less, as you kind of saw on some of the slides. But that impact is very different than, someone paying off a collection, which is not going to generally have an immediate impact, surprisingly, because it's already gone to collection and already been like stamped as like crap, like what happened. And so that can be challenging at that stage. But those credit card utilizations can definitely be the quickest thing that someone can do, assuming they have the funds to do it.
Right, right. Okay, next question is, why is their credit score different from Credit Karma? And I imagine like other things like Credit Karma too included in that.
Yeah, so that is a good question. So it kind of goes back to that soft pull mechanic. But even Credit Karma and a lot of these companies that they're not doing hard pulls usually, they just use a different scoring model than mortgage lenders do. So they typically use what's called a Vantage score. And then on the mortgage side, we use some older FICO models specifically designed for mortgage lending. Credit Karma and a lot of these soft pull things, they can be actually, like, as much as I knock on them, because it is frustrating when you're dealing with someone, you're just trying to help them. And the understanding can be hard to come across. The positive side of soft pulls or Credit Karma in general is they do a great job at providing a trend. Because if a trend on Credit Karma or whatever is trending upwards or downwards, it's probably a pretty good indicator that your underlying score for mortgage purposes is trending upwards or downwards. What it's not good at is giving you an actual score if someone's trying to get a mortgage and relying on that score, because it can be 20, 30, 40, 50, 60 points different. And could mean all the difference in getting a mortgage or not. So they just use a different model, and that model is not the same as what mortgage lenders use. So that's the simplest way. It's just not the same model.
Good answer on that one. We have another question.
Okay.
What's the absolute worst score for most lending options, and what should we pre-screen to aim for with buyers?
Listen, as far as credit's concerned, most people, just like how much money they make and their debt structure, most people, when you ask them, they don't really know, because and certainly because they'd be relying on soft pulls. So for example, like I have a Discover card that tells me my credit score every month, but it's a soft pull, so it's like, who even freaking knows? And so it could be challenging for you to pre-screen it. That was my only thing there, is there's not much you can do, because what you don't want to do is, certainly from your guys' perspective, is turn someone away or make someone feel like discouraged, because that's really not a good thing to do regulatorily. You don't want to discourage them from filling out a mortgage application or going through the mortgage process. For any credit related events especially, you want them just to be able to go and pursue it. Worst score, I mean, once you can start getting below 620, and just keep in mind, this is all just an asterisk, because everybody's credit profile is different. Even with two people with the same score, the underlying mechanics of how it gets to that score can be different and can be viewed differently when you're trying to get underwriting approval. But 620 seems to be, once you start dipping below 620, it can be challenging for numbers of reasons, whether it be the cost and getting approvals and just different things like that. So sometimes when someone gets above 620, it can be pretty beneficial, that jump at least, that you see. And certainly above 640 can start getting pretty beneficial as well. But that being said, all of them can at least benefit from some good advice at the end of the day.
Yeah, I would say, like, if you're asking the question, because it can sometimes be helpful to know how long you want to, maybe, like, are you going to go show them a home without a pre-approval kind of thing? To give you an indication, like FHA and VAs is a minimum of 580, but just because you have 580 doesn't mean you're going to get an approval, because that's a pretty blemished profile. So if you want to use it as an indicator as to whether or not you're going to go out, how much time you're going to dedicate before that pre-approval, like that 620 is a good rule of thumb, I think. Okay, next question, although we're 1 minute over, but those that need to can hop off. But we're gonna jump to this next one. And Oh, it just says, please send the PDF of the credit score do's and don'ts, which we
Okay,
will
cool.
absolutely do. We'll send the recording of this class afterwards, along with a copy of that PDF. So you can use it. It's really great. Like I promise, consumers are super hungry for credit information. And so reaching out to your database.
If you want your email to get opened, send something credit related. That'll
Yeah,
open it. That'll
true
open it.
statement.
That'll
Yes.
open it.
All
Awesome, you
right.
guys. Well, thank you
We'll
so
see
much
you
for
on the
everyone
next
getting on
one.
here. See you later.
Bye.